Hey guys, welcome back to our Flip Trading podcast. I'm your host for today. I'm Brian and I'm a leader here at Flip Capital. Now, with us today is an extremely experienced industry player, right? Lawrence. Hey Lawrence, how are you today?
Hi, Brian. I'm doing good today. Thank you.
It's great to hear, man. I'm doing great too. Okay, now before we start, please take note that this presentation has not been reviewed by the Securities Commission of Malaysia and is only for general educational purposes only. It is not an invitation to buy or sell any investment products. Hence, the speaker and PCSB, we are not liable for any financial decisions that you may make based on this presentation. All right, now back into the core content. All right, this podcast is a preview for our upcoming webinar with the speaker, Lawrence, titled CME Micro Treasury Yield Futures, Insight Strategies and Trading Dynamics on the Thursday, May 23rd of this year. If you are interested in the Treasury Yield Futures that often hints on how the US market is likely to unfold, don't forget to register and tune into the webinar. All right, now before we start, let me just quickly introduce our honored speaker with us today, Lawrence Lee Liang Wei. All right, so Lawrence is the current Chief Investment Officer at Continuum Alpha Wealth Management, an independent asset management firm, right? So he develops and oversees the overall investment platform, representing the firm's investment views, strategies, and all related investment products and solutions to risk managers and ultra high net worth clients, right? So prior to Continuum Alpha, Lawrence was a chief investment officer at another enterprise asset management for 5 years, managing a whopping asset under management of $4 billion US, right? So Lawrence has 15 years of experience across major asset classes with fund management experience in both the private wealth and institutional space. Lawrence has also worked at UOB Global Markets Division, where he co-managed a USD 8 billion global fixed income portfolio, right? Lawrence has an honors degree in economics from the National University of Singapore. And in addition to all of that, he is a CFA charter holder and a certified financial risk manager. Wow, what an amazing resume. So I won't hold too much of your time. I'll pass it to Lawrence to take over the show from here. All right, Lawrence, go ahead.
Okay, thank you, Brian. Very quickly, let me share my screen. Okay, so before we start, I think interest rate is something that's very close to my heart. I started my career in the industry as a FX and interest rate trader. I think for interest rate is something that I think everybody knows is important. Okay, but it's not that easy to actually relate to it, unlike like equities or FX. So for interest rate, it is important. Okay, and a lot of question, I think a common question people have often is, what is interest rate? I think simply put, it is the cost or the price of borrowing money, and actually affects everybody via various transmission mechanism in the economy. Simple examples will be at an individual level. Interest rate affects your saving rates. How much do you get out of your fixed deposit or from your bond investment? It affects how much you pay in housing and car loan. So typically, the higher the interest rate, people tend to save more. They don't spend. They spend lesser in the economy. So it affects the economy. For corporations, interest rate affects whether the business wants to make a decision to invest in expansion because of the cost of taking loans for business expansion. So similarly for government also need to borrow. They need to borrow so they can spend on healthcare, infrastructure, social defense, social security. So for government, the cost of interest payment on government debt is also affected. Even for financial asset, stock market valuation, everything, how stock market is being valued is often the discount of future cash flow. So interest rate is also a big factor in affecting the stock market or financial asset valuation. And then in terms of currency, how much your currency is worth, is it going to be expensive, cheaper, is also driven by interest rate. Typically, higher interest rate, higher interest yielding countries will attract inflows to the currency, and the currency will get stronger. So we can see from here that interest rate is actually something very important, and it affects everybody. So with that background in mind, we move on to who actually sets the interest rate and monetary policy. So there are central banks in the world who set monetary policy for their respective country, but I think the most important central bank in the world is the US Federal Reserve, otherwise known as US Fed, for two simple reasons. The US dollar is the reserve currency of the world, and the US is the biggest economy in the world. So whatever the US Fed does, it affects the US interest rate, it will affect the rest of the world. So the FOMC, which is the Federal Open Market Committee, is a branch of this US Fed, the central bank, that determines the direction to monetary policy. And every year they will hold 8 regularly scheduled meetings. The last one just ended on May 1st, and the next one, I believe, is on the 12th of June. Although, if there's a need for it, they can also hold ad hoc meetings. Just like COVID, if they see a need to do something urgently, they can hold meetings outside the 8 regularly scheduled meetings. So financial market will often like to guess whether the Fed will, tighten, which in our term, we call it becoming more hawkish, or they will ease, otherwise also known as being more dovish, the monetary policy. So when they are more hawkish or when they tighten, interest rate will go higher, and vice versa, when they are more dovish and they ease monetary policy, interest rate will go lower. So with this, it generates a lot of volatility in the market because market starts to anticipate what the Fed will do. So the Fed, it's also very important to know that the Fed actually has a dual mandate for monetary policy. Okay, they are namely, number one, to pursue maximum employment, and number two, price stability. Otherwise, people commonly will refer that to as inflation, to maintain prices at a stable level. So with that backdrop in mind, now we look at the economy. So we know that, so this is something that we have built in-house to monitor the global inflation heat map. So if it is very red, it means the CPI in the country is very far above the central bank target. Similarly, if it's very blue in color, it means it's very below. So from Jan 22nd, you can see that there was a global inflation in the world at the time. So in the US, Jan 22nd, it was as high as 7.5%, and ultimately it went to a peak of 9% in June that year. Although, so you can see that the picture there's a picture of global disinflation that's going on for the last 1.5 years. Okay, as you can see, the red becoming less red, going gradually to white. Notably, in this diagram, you can see that Switzerland, Italy, and China are blue. So China, as you know, is battling a deflation problem. Pretty much the reverse of what the whole world is going through. For China, they're having a deflation problem. But I think if we shift our focus back to the US, we can see that there's a disinflation, but in the last few months, it has stopped going down. Okay, meaning inflation is still a problem. It is not going down to the Fed's target. I think that's an important message we take from this slide. So for the Fed, they look at inflation. So the red line is what market perceived to be the Fed's target at 2%. So if you look at this diagram, you can see that inflation has come off from June 2022. It has come down, but it has not come down to the level that the Fed is willing to loosen monetary policy. Because if we look at the component of the CPI, you can see that the blue bars, which is actually services inflation, is still very, very high. Although goods inflation, the yellow bar, has come down and probably has bottomed. So for the inflation, you can see that the component of inflation is also important because inflation is defined as the price of goods and services. So now the price of services is still very elevated. And the problem here is services inflation, which is what you pay for, education, tourism, hospitality. This is the component of inflation that usually prove to be stickier, proves to be harder to come down to the Fed's target, and hence Fed would be slower to loosen their monetary policy. So this is what is happening in the global economy now. So earlier we mentioned that the Fed has two mandates. One is maximum growth and one is inflation. So during the webinar, I will share more colors on the rest of the economy other than inflation. Actually, to show a picture that US is actually doing very well economically. And hence, the Fed has less pressure to actually cut rates. So if you look at this chart, you can see that at the start of the year, financial market was of the belief that Fed would be cutting interest rate by 6 to 7 times this year by the end of 2024, which was about 150 basis points. That was at the start of the year. However, with better economic data on the employment front, on manufacturing front, and most importantly, inflation proving to be very stubborn, the Fed sees less need to actually cut rates. So with that, market has repriced itself. You can see from the blue bar that currently, it's not just in the US, but across the world, there's this repricing that has gone on. So now market expect probably Fed might cut 1 to 2 more times this year because the economic conditions doesn't warrant them to. So if we look at the Federal Reserve, this is the Fed fund rate since 1990s. We have seen that they are up and down, often in response to changing economic conditions. So you can, I think something more recent would be in 2008 when the financial crisis happened, the Fed cut rates all the way to zero to try to revive the economy. Then rates stayed very low until 2015 that they started creeping higher. And then COVID came. Again, the response by the Fed was to cut rates, pump liquidity in the system to try to get aggregate demand higher in the economy. So that was COVID, and rates came all the way down. Then most recently, in the last 2 years, we see inflation going higher, and the Fed, because of the dual mandate again, was forced to react. So they first increased rates in March 22 by 25 basis points. And then from June 22 onwards, in total, they have hiked rates 11 times to bring it all the way to the current level of 5.25 to 5.5%. So in between, it's also crucial to note that the Fed often does not need to move. They often move in 25 basis point increment, but they do not need to if conditions warrant it again. So in the last from June 22 onwards, they have actually hiked rates on 2 occasions of 75 basis points at one meeting because they felt the need to arrest the very high inflation then. So I think it's best to look at the Fed. I think a good analogy would be to look at them as a doctor. So if the market is doing, if they feel that the patient, which is the economy, is having a fever, they will start to administer the drug to bring the fever down. And that drug is actually to increase interest rate because that will cause aggregate demand to come lower. And they feel that the patient is having hypothermia or very cold, they would actually want to bring the temperature back up. They would ease monetary policy by bringing interest rate down. That is why you see that fluctuation in the Fed fund rates. So that was the background to actually understand the US interest rate, like what are the drivers of US interest rate. So Federal Reserve, the Fed actually drives the Fed fund rate according to the economy. So earlier we also mentioned that the US government, they also need to borrow money because they need to spend. They need to spend on infrastructure, social security, defense, so they need to borrow money. So the US government, when they issue bond, sorry, the US Department of Treasury, which is also the Ministry of Finance in many countries, they have to issue bonds to borrow money for the government. So in the US, the government bond is also known as the US Treasury. So the US Treasury market is the largest and most liquid interest rate market in the world, simply because the US is a big borrower. As of 2024, the total outstanding debt is US 34 trillion. That is a very, very staggering amount. So when they issue this bond, at the auction, this is the primary market. Because of the regular schedule that they are borrowing money, it is very frequent. So the next time that the new bond is being issued, the old ones will be known as secondary market. So it is a very, very fluid market. It's also very important to know that the US Treasuries are deemed as a very safe and flight to quality instrument because they are backed by the full faith and credit of the US government. So very liquid in terms of crisis, people will buy US Treasuries because they believe that the Fed will cut rate. So that is the kind of dynamic that is going on. So to reiterate, the Federal Reserve, they conduct the nation's monetary policy in pursuit of two goals: maximum employment and stable prices. So are all bonds similar? So if you buy a 2-year bond, 5-year, 10-year, or 30-year, are they all similar? The answer is no. So there's this thing known as the term structure. That means that they are similar quality bond, but the interest rate of different maturity, a different tenor would be different. This is known as the term structure of interest rate. The reasoning is very simple. If you are an investor and you buy something that is 10-year versus something that is 1 year, your risk is naturally higher because the duration risk is higher. So you would naturally ask for a higher term premium, which is the additional return you would ask to compensate you for the additional risk. So this gives rise to what interest rate people always call a term structure. So this term structure can be either upward sloping, downward sloping, or flat. So in today's context, the curve is known as downward sloping. Okay, because the front end yields are higher than the long end yields. So in the webinar itself, I'll be touching a little bit on this and also explaining the concept of duration. What is duration? Which, how does it affect your decision when you choose to buy a 2-year bond versus a 30-year bond, for example? So interest rate, as I mentioned earlier, is something that most people find it very hard to relate to because unlike shares or FX, you can trade those very easily. You think a price of a company, you think a company is going to do well, you think the price is going up, buy the shares, and it's very easily available. But for interest rate, the instrument to express your view whether you think interest rate is going higher or lower are more limited. So bond is one, but to really express a view on US interest rate, you could only buy government bond, and it's not so easily available to the average investor. So in 1977, the first US Treasury futures were launched. This is what we refer to as the classic US Treasury futures. These were mainly for institutional use. So when I was trading for a bank, we used to trade this. These are very, very liquid. As you can see from the diagram here, they are also very complex. Okay, they go from 2-year, 3-year, 5, all the way up to 30 years. And if you notice that they have differing face amount, differing tick values. So it is not the easiest, it's not the most intuitive as well because they trade in price term. So there is also an inverse relationship between bond prices and bond yields. So this is something that I'll be sharing in the webinar itself. So I think a lot of people always just try to memorize and say, oh, higher bond price means lower interest rate and vice versa. There's an inverse relation. So to trade the traditional or the classic US Treasury futures, you have to remember this. this inverse relation. Because if you think that treasury yields are going lower, you must know that you are supposed to buy the bond price. That is one. And the second issue with this for a general investor is they trade in 30 seconds, which is the traditional way treasuries, US treasury bonds are being traded. 30 seconds means they take 1% point is split into 32s. So 1 over 32 is 1 divided by 32 is simply 0.03125. So the convention becomes a bit tricky for people who don't trade it regularly. And also these are physically settled. So if you hold the futures and you hold it to expiry as a holder of the contract, you either have to take delivery or you have to deliver the bonds to the other party. And for physical settlement, there are also a lot of things to consider, like there's going to be a basket of securities. So what is the cheapest to deliver? And these are concepts that are not necessarily very, very easy to understand to people who are not interest rate traders. So these are also the things that I'll be touching on a webinar to illustrate how the typical institutional investors look at this. So CME this year, they launched something known as micro treasury futures, which they for a start, they launched two points. One is the ultra 10-year and one is the ultra T-bond. So the difference between this and the treasury futures classic, which I showed earlier, is that they are 1/10 the size and they are cash settled. So it is meant more for retail investor. However, the rest of the features are the same, meaning they still trade in an inverse manner. They still trade in 30 seconds. So these are still some of the things that could not really be very intuitive to the average investor. So the focus of this webinar is actually on the CME Yield Futures. So the CME Yield Futures were designed actually to arrest all the earlier concerns of either the classic or the micro futures. So CME Yield Futures were launched in 2021, and they have actually 5 features to make them more friendly to the average retail investor. Number one, they will trade in yield and not price. So if you think that inflation is going to go higher, you think that the Fed is going to increase interest rate, heightening the interest rate, you expect the yield to go higher. So for this, very straightforward, you just buy the yield futures because it's actually not trading in an inverse relationship. And number 2 is cash settled. So again, no requirement for physical settlement. It's very clean. There's no operational risk. And number 3, it is also very small size. So it trades in basis point, and every 1 basis point is only $10. So the contract size is very small. If you have a view and you don't want to put on too much risk, it's also very, very good, just to put on the trade. And there's no basket of deliverable securities, unlike the classic treasury futures. So you only follow one single on-the-run security. So very clean, less ambiguity. And more importantly, the risk exposure and duration is constant at $10 DVO1. So DVO1 is a concept that I will also explain in detail during the webinar. It's a very important interest rate concept because it actually shows how much risk you actually have when interest rate moves up or down. So the fact that this has a constant DVO1, this feature actually removes the convexity and non-linear relationship between price and yield. So it is very, very clean for CME yield futures. So this is a very quick summary why yield futures are a lot friendlier. They are a lot simpler to understand. Say number one, they are traded in yield, hence the name. Again, they are cash settled. You don't have to worry about delivery, worry about operational issues. The DVO1 is constant at $10, regardless of which maturity you trade, be it the 2-year or the 30-year. It is set at $10 per DVO1. This makes curve trading very easy, which I will also elaborate in detail during the webinar. The tick size is very small. 1/10 of 1 basis point is only at $1. So it allows very, very granular price movement and granular risk. And yeah, so there's also 2 monthly contract and they have four maturities. So the webinar itself, I'll be explaining all this concept, explaining the features of this yield futures, and also I'll be sharing more on the US economy, the US interest rate outlook, and also we'll be sharing 3 to 4 case studies to illustrate how you can use yield futures on different tenor to actually express your view, and also how to use yield futures to create curve trade, market neutral or delta neutral strategies like curve trading, flattening, and steepening of the yield curve. So this will be all covered in the webinar next week. So for this podcast, I hope I have given you a very good background to what is US interest rate, what are the drivers for it, and the way to express your view in the form of CME yield futures. So looking forward to seeing all of you in the webinar. That's all from me from now. Over to you, Brian.
All right. Wow. All right. Thank you, Lauren, for the insightful sharing. So for those interested in more content like this, don't forget to tune in to our webinar on the 23rd of May of this year on Thursday with Lawrence. Also, now before I end the podcast, for those interested in trading yield futures or other US products, Phillip Capital is currently running a promotion from the 1st of May all the way to the 31st of July called Trade CME Micro Futures with Phillip, where you can stand a chance to win cash rewards up to 1,500 ringgit, as well as a welcome bonus of 88 ringgit for new clients. For more information, visit our website, phillip.com.my, for more information. All right, so thank you all for tuning in, and thank you, Lawrence, for your time. It was a pleasure having you, and I will see you guys soon.
Thank you, Brian.